Hey guys, welcome to SIH Capital Group monthly webinar series. This is the February edition. I'm really happy here to have someone I've learned a lot from in the past. I was a big fan of his podcast. I asked him to help me with a book that I was writing a few years back. We stay in touch. I've used them for my own life insurance policy, so I'm really honored to have MC here. MC, I'll let you do the introduction so I don't butcher it, because you'll do it a lot better on yourself than I would.
No, appreciate it. Yeah, MC Laubscher here. One of my companies that does the life insurance that Dennis was referring to as Producers Wealth. I started Producers Wealth in 2015, and I started it completely virtually. So now everybody's doing everything virtually. So it was interesting. Actually, this is a fun fact about it. The reason why I decided to do it virtually was that I did consulting back in, I think this is like 2010. Yeah, around 2010. And I did consulting, and we had a meeting at Amazon. And I remember we walked through the building, and I walked past the boardroom, and there was someone sitting in a meeting by himself in the boardroom. And I asked the person that was taking me on this tour at one of Amazon's offices, that I'm like, what's happening here? Why is that person sitting there by themselves? And he had a big screen on, like a monitor, and people were using Skype. This is pre-Zoom. So there was just a bunch of people calling in from all over the world on Skype. And at that moment, I'm like, this is unbelievable. This is how the world, why would you do it any other way, right? Consult and do business and meetings and this kind of thing, because you can get people in from all over the world. You could talk to anybody at any given point in time and help people and conduct businesses with anyone. So I started a virtual, and we work with business owners and investors in all 50 states in the United States. And also I have a show, as Dennis mentioned, Cash Flow Ninja. That started in 2016, where we talk about cash flow. We go very wide, everything cash flow. We cover all asset classes: business, real estate, commodities, paper assets, crypto and blockchain assets we've covered. We've really covered everything that we possibly could on that show. And yeah, I mean, I started in 2016, and now it's almost, what is it now? We're in 2023. So it's almost 7 years later, millions of downloads. I think we just hit 5.5 million in 180 countries. So we just keep plugging away, and it's turned into an education company where we now have books, newsletters, and also a mastermind where we help business owners and investors protect and multiply their wealth during turbulent times. So what I wanted to share with everyone tonight, however, is a place to warehouse cash. One of my strategies right now is trying to accumulate as much cash as possible. I believe that we're at a time period where it makes sense to accumulate a lot of cash, because if your businesses or investments need some influx of cash, now you have access to it. If things go on sale, now you have access to it too. So it makes sense to have it. Very good stabilizing factor, a lot of uncertainty, a lot of volatility, and it makes sense to have it. Where do you put it though? That's the big question, right? Where would you put it? Because one of the biggest themes, I would say, for the past 2 years, and this is going to become a very big theme in 2023, is counterparty risk. Everybody in the crypto space have figured out what that means with FTX and all the platforms going under, BlockFi, Celsius. That's counterparty risk. And counterparty risk is where the party that's responsible to make good on promises. So if you put your cash in a bank, the promise is that they made to you there is you've borrowed their money. That's how this works now legally. And the promise is when you need your money, they'll give you your money back. Now, in the fine print, lawyers will argue with me that they don't really have to do that, but let's just pretend that they still have to honor it. That's counterparty risk. So you are relying on someone else to make good on their promises. That's going to be a very big theme. It has already, like I said, in the crypto space. It's going to roll over into the financial industry space, and it's going to roll straight through the economy into the banking space. So be very careful with counterparty risk. How do you analyze counterparty risk? Here's a lesson that I've learned in my short life, my short time on this spinning ball of dirt, 44 years young. When you are trying to figure out how people and businesses and institutions will behave in the future, you look at what they've done in the past. And usually the probability, it's a very high probability because we're in the game of probability of outcomes, right? As investors, usually the probabilities are pretty high that they're going to do similar things in the future than what they've done in the past. So when it comes to the cash conversation as one piece of a strategy, you've got cash, you could have your wealth insurance, your metals, your gold, your silver. You could have your cash flow investment portfolio in alternative asset classes and have some nice diversified income streams from it. And then you could also have an area allocated towards growth, capitalizing on trends, opportunities, whether it's investing in, I don't know, what are some of the big trends these days? AI, robotics, all those industries, or in massively distorted marketplaces, capitalizing on that. Stupid things that the government does usually leads to distortions in the marketplace. Great opportunity for investors. I'm going to screen share here quickly just to share with folks. What I wanted to share is talk about what we do at Producers Wealth and also why it's such a great place for cash right now, the vehicle that I'm going to share with you. So I'm just going to go to slideshow. Okay. So some of you might have seen this. I've updated a lot of this stuff and threw some new things in here, but the vehicle that I'm going to share tonight with everyone is the Producers Capital account. And as Dennis mentioned, this is a life insurance vehicle. I call it the Producers Capital account. Now, what's a producer? A producer, I'm going to sound a little bit Ayn Randish here, so bear with me for a second, a little bit of Atlas Shrugged in the mix. A producer is someone that produces and create value in the marketplace, and exchange gets capital. So the producers that we refer to as business owners and investors, because business owners and investors, what they do is solve problems in the marketplace. And by solving problems in the marketplace, they create value in the marketplace. And as a result, they accumulate capital. So the producers are business owners and investors. Now, the question always becomes, remember, the quality of our life is determined by the quality of questions that we ask ourselves, because that impacts the level and the quality of our thinking. What's the best place for business owners and investors to keep their capital? I would argue it's in a place that they can access that capital to grow their businesses and grow their investment portfolios, not in a place that totally restricts them accessing that capital, which is basically what the majority of business owners and investors are sold. So let's talk a little bit about a strategy. Let's zone out a little bit. Now that I've shared what a producer is, we're going to talk about the Producers Capital account. Let me share with you where it fits in. I'm a big framework person. I love frameworks, and I love frameworks because a framework that's put out there is something that you could utilize regardless of where you are on your journey. You could take something from it. And this is a framework that I put together after interviewing 800 of the best minds in business and investing. I've studied millionaires, multimillionaires, billionaires for 2 decades. They all have these pieces in place. I call it the aligned capital strategy. It's aligning the capital of the producer behind the producer. And this will have a multiplier effect in their strategy. So what are some of the elements? Capital creation. We all create capital in one way, shape, or another in the economy, whether as an employee, a self-employed person, a business owner, or an investor. We all create capital somehow. So once we've created capital, we've got to position it somewhere, and that's where capital capture comes in. We're capturing the value of the capital that we've created. It has to reside somewhere. You have to warehouse it somewhere before we then leverage it and deploy it into the marketplace and generate cash flow. Investing in assets that pays us to own it, cash flow. There's upside potential because the value of the asset will increase. There's great tax benefits, and we can leverage the skills, capabilities, capital, and network of other people. The fourth element is capital growth. That's where you position capital in areas where there is great opportunities. Capitalizing on trends is a big one, right? And then capitalizing on market distortions, government doing stupid things, creating opportunities for us to capitalize on. That's the fourth one. And then the fifth one is capital control. That's where you build a wall around everything that you produce and create and deploy and a position for growth. And this is one of the most important things right now. I know I'm going to talk a little bit about a strategy and cash flow management and so forth, but really right now, if I can add value to folks, I would tell them that this is the primary focus of mine right now. And I see it as an investment. So what's capital control? It's protecting you from wealth destroyers, because they're there and they're coming at from all sides at you. So what are taxes? You have to have a tax strategy. So by having a tax strategy, you want to have a team. You want to have a CPA, a tax strategist, a tax lawyer. There's 87,000 IRS agents that's not going to get bored. So what are they going to do? You want to be in a position that you don't care if you get audited or not, because all your ducks are in a row and your team handles that. That's an investment. That allows you, by the way, to keep on focusing on producing and creating, having that in place. The other thing is asset protection and estate planning. Most business people and investors, they set up LLCs and they set up a trust, and that's it. They don't even review it every 6 months or a year. They literally, you know why I know? Because I have these conversations with folks. MCI set it up 5 years ago. I haven't revised it or looked at it, and we've had more kids. We just haven't updated it. Make sure that's updated. Make sure that you have a legal team on top of that, because in economies that are getting worse globally, for the majority of people, at the top, it's still going to be great. There's going to be lawsuits. There's going to be lawsuits. So you want to make sure that you don't have any blind spots there. The fourth piece, so I've mentioned tax strategy, I've mentioned asset protection and estate planning. By the way, just one aside note on estate planning, in 3 years, that's changing too. I think the exemption, because there was an inflation escalator built in on that, it's probably around 26 million right now of exemption for estate taxes. That's going to be cut in half in, I think it's 3 years, 2.5, 3 years. So you might want to have a conversation with someone if you have a net worth that's over 13 million. I would argue if you have 5, you have to sit down with someone. And then the fourth piece of that is risk management. Think of health insurance, disability insurance, property and casualty insurance. Think of all the different types of business insurances, captive insurance, and so forth. Make sure all of those things are in place. That's an investment too, by the way, because having those things in place is going to allow you to focus on capital creation and generating more capital. Not having that in place is going to leave you vulnerable to attacks. You don't want to build up things. The last thing that you want to do is protect what you have and multiply what you have. And then all of a sudden, because you didn't take care of that, 5 years down the line, you lose half of that or 75% of that because of something, that you should have had in place that you didn't have in place. I just want to go into our economy. By the way, one more thing that I forgot to add here is under capital capture. That's where your producer's capital account comes in. That's where that comes in. 3 different realities: borrowers, rat racers, and producers. Everybody's seen this. This is the reality of the majority of people in the economy, unfortunately. They borrow, they pay back, and they borrow more. They're always just trying to get back to even Stevens. The rat racers, there's some good habits there. They save some money up, but then they spend it, and then they draw it down, whether it would be for automobiles, homes, education, and maybe some toys like a boat and so forth, and some assets. But they're always drawing it back down. So what producers do is they build up capital, right? The big thing, a little bit back to Ayn Rand and Atlas Shrugged, honest people in an economy never consume more than they produce, right? You produce more than you consume. And the difference is savings, and you just accumulate that savings. And eventually you put that in an asset that could be placed as collateral by a financial institution. And once that happens, you'll have compound interest in that asset, and you get to leverage that asset to acquire credit lines. And this is the game that producers play. And there's a lot of different examples of it. And I'll get into that, but just quickly, this is the difference between a borrower and a producer. Let's just say a borrower borrows $50,000 at 6% interest. And let's just say the borrower pays that back over 25 years. So the producer saves 50 and puts it and earns that 6%. What does it look like in 25 years? You could see the interest that was paid was $46,645 with zero final balance. Remember, the borrower is just getting back to even Stevens. The producer earned $164,593. And if you add the starting balance of 50,000, then you'll get to 214,593. Pretty big difference between those two realities. I know which one I want to be. The reason why producers are able to position capital in an asset and establish a credit line against it is that they have positioned it in an asset that an institution, financial institution, sees as collateral. Now, collateral is just an asset a lender accepts as a security for a loan. And collateralization being, and this is how I define it, just keeping it simple, I'm using one asset to acquire another asset. Now, what can you use as collateral? There's a ton of stuff. And most people that are watching this are aware of this. So real estate, everybody knows you can access the equity and place the equity as collateral for a loan, such as a HELOC, home equity line of credit, or you could cash out refi a property and use the proceeds then to roll it into another property. Business, we had someone in our network place the business, the assets and the receivables of the business as collateral for a loan, which that person then used to buy the property from which the business was operating. So now this person has a business in that building, and now they own the building too. They use the business to buy the building. And by the way, there's 3 other tenants in that building now paying rent, using one asset to acquire another asset. Stocks, everybody looked at Elon Musk. Elon's deal with Twitter was all over the news. By the way, fun fact, how incredible from a marketing strategy, and Elon's got a team, how incredible was that you basically have World War III breaking out. You have a pandemic, you've had all this stuff, and everybody was talking about Elon's deal. That's pretty good in a world full of noise. But anyway, what was important about that deal for me was how it was structured. And Elon placed a lot of Tesla shares as collateral to get an asset-based lending loan at a very low interest rate, which he then used to finance. So he put up the majority of the cash to finance, and then investment banks were fighting over each other to come up with the rest of the money for him. He did that using a stock as collateral. So you can do that. CDs, I had a mentor doing that 20 years ago. We would put 100 grand in the bank. The mentor did that in the 70s, by the way, not 100 years ago. In the 1970s, they paid double-digit interest rates on that 100 on any CD. So you'd put the $100,000 in the bank. They would pay him a double-digit interest rate, and then he would then go back to that same bank, get a loan of 90% of what his CD was valued at, or at that stage. And then he would use that money to go buy real estate. He has his CD earning, let's just say 10, 11, 12%. He borrowed it around 10. And now he took that $90,000, bought real estate with it, that cash flows, and he's paying back the loan. His CD still growing in the one vehicle, and he has real estate now that he owns in the other vehicle. Gold, silver, art, I've done that. You could place your gold, silver, and art as collateral for a loan. Cryptocurrencies, same thing. You could place your Bitcoin as collateral for a loan, and then life insurance. With all of these, you have to be careful. With stocks, don't try this one at home, kids. If you don't understand how to manage margin and manage collateral, same thing with cryptocurrencies. That's where you could really burn your fingers, like a lot of people did. When markets go up, great. When they come down, you're going to get margin calls. You have to know how to manage collateral. My favorite one of all of these, I've done real estate, I've done business, I've done gold, silver, art, and I've done cryptocurrencies. My favorite one is life insurance. And I've done that one for now 14 years. So that's my favorite type of collateral, and I'm going to share why it is the producer's capital account. So a well-structured dividend-paying whole life insurance policy with a mutual insurance company. Remember, there's stock companies, and mutual insurance companies are not listed on the stock exchanges. They are owned by the shareholders, which are the policyholders. So mutual insurance companies are playing a completely different game than what stock companies are playing. So The policy, if it's structured correctly, you'll have your principal and your growth guaranteed in the policy. You're going to get access to dividends. It's not guaranteed, but one of our carriers have paid them since 1847, every single year. It's tax-free, by the way. The growth and the dividends are tax-free. You can access it tax-free, and you can get distributions as income for retirement tax-free later on. There's disability riders that you can add to this policy. So if something were to happen to you, you don't lose the policy. The insurance company would pay that. And then also you get a tax-free death benefit at a multiple of the cash value. There's asset protection in most states. Check with the state that you live in. I don't pretend to be a lawyer. On YouTube or any media format, check with the state that you live in how it works. But in Pennsylvania, for example, the cash value in a whole life insurance policy has asset protection, same as Florida and Texas. It is privacy. It's a private contract. Nobody knows that you have it unless you put it on a form and hand it to a bank or you declare it somewhere. It's a private contract. Policy loans directly from the insurance carrier doesn't go in your credit report. And also it's great as part of a family and a business continuity strategy. So we do a ton of family and business continuity planning. If you compare the producer's capital account to the other just types of collateral that I've mentioned, it's a no-brainer. Guaranteed principle of growth you have in the life insurance, tax-free growth, tax-free access, credit line access. So I put 90% in here. You could get up to 95%. We actually have a resource, a bank that will give you 100%, a line of credit of your cash value, tax-free distribution, and a death benefit. So if you look at gold, silver, art, very sexy to having that conversation of using your gold as to get a loan to go and buy real estate, but I can only get up to 50%. Same with crypto, same with stocks. And if you compare it to other savings vehicle or other areas or vehicles that people save money in, you could also see that it checks all the boxes: tax-deferred growth, tax-free distribution, competitive return, high contributions, additional benefits, collateral opportunities, safe harbor, no loss provisions, guaranteed loan options, unstructured loan payments, liquidity use and control. The only thing it doesn't have is you cannot deduct your premiums from taxes. And you don't want to do that. So you want to pay taxes now on the seed, not the harvest. What does it look like? So we fund the policy. It is guaranteed growth. It gets dividends. We collateralize the cash value, which is the equity in the policy, to get a credit line, which we then use to purchase an investment that produces cash flow, which we then pay the policy loan down or the credit line down. And we just do it over and over. So the advantage of doing it this way is uninterrupted compounding, taxes, you have a treasure chest, a war chest, capitalizing on opportunities. You can benefit from inflation because your money is working in different places simultaneously, not just in one place. And also, if you look at inflation, if there is inflation, there's inflationary profits in life insurance companies too, which will eventually go through to dividends, which these companies pay. And you avoid losses. That's the other big thing. You don't want to lose. You want to be able to have your capital in a place where it's not being drawn down or you lose it. And how do you design this? So this is the other thing. People are like, this is great. MC, how do you design this? The first thing is you want to design this policy so that it's specifically designed for high cash value day one, but you want to have flexibility of funding. So you want to have a minimum and a maximum, and you don't want to be restricted of when you can add to the policy in the set amount that was decided on when you set it up. You want to have a catch-up provision. So for example, let's just say you have a minimum and a maximum. Your maximum is 100,000. Let's just say your minimum is 30,000. Let's just say you put in 50K the one year because you didn't have the full 100. The next year you have a liquidity event. Now you do have money. Can you go back and put that in the year that you missed? Yeah, you can. You should have it that way, and you should have it structured that way. You should be able to set up a line of credit as soon as possible. 30 days is how long it takes now. It used to be right away, but over the past year or so, now it's 30 days. You shouldn't have any fees. You shouldn't be charged any fees for setting up a credit line. And there shouldn't be a required interest payment monthly. And by the way, annually too. The interest payments due at the end of the year, you can actually roll that into a loan if it's set up properly. And then you should have different provisions in there, 2 different riders for different types of strategies. So this is essentially how we design it. Very quick 70-30 split. Basically, you buy the life insurance. And by the way, I am really generalizing here. This is based on your age. This is based on your insurance underwriting. But most people say, MC, what kind of does it look like? 30% of the premium will go to the life insurance, 70 to the cash value, if I have to very much generalize. So let me share with you a couple of examples here. I think this is what everybody wants to see. So here's an example of a female that is 40 years old that is set up a policy. And what she's doing is she's going to throw in $100K in year 1 into this policy. And then she's going to continue to fund this policy, $50,000. And she's going to do that. Let me just make sure till age 70. So let's go back here. So let's take a look at her policy. Again, you know, if you're a different age, your policy is going to look different. If you're a male, your policy is going to look different. Even if you're 40 years old, there's different underwriting for men and women. Fun fact, women statistically live longer than men. There's probably a lot of reasons I could list for that, but they do. I guess men do a lot of silly things earlier in their life, and would they continue to do that? But back to the policy. So you could see the 100,000 she dumped in. So this is your end of year values, the total net cash value column. But you could see, because she's a female and she has gotten one of the highest or best underwriting things, that there's $78,000 in her policy, in the equity of her policy. So her policy looks a little different. And you could see that she'll have about 95% of that available. And it's not going to be exactly 78,759 after 30 days. These are end of year values, but it's going to be pretty close to that. It's probably going to be closer to 75,000 now that I look at it this way. But she's going to be able to get access up to 95% of that within 30 days to go and buy real estate or use in whatever manner she decides to use it. Then from year 2, she puts in 50. So she's lump sum, she's thrown in $100K. It was money just sitting in a bank doing nothing for her. What are some of the negatives in doing this? You could see the first year, she doesn't have $100,000 in there. And you could see there's a negative column. There's 3 years of negative in change in net cash value less premium outlay, that column. And what that is essentially you're buying the life insurance the first couple of years so that you can pour capital into this policy and throughout the life of this policy. So you could see that within 7 years, there's more money into the policy than what she's contributed in premiums. And in 10 years, there's 550,000 that went in. There's about 630,000 in there tax free with a death benefit of 3.1 million. As you can see, the death benefit continues to grow every single year as well. So this isn't for people that's just looking at year 1. It also isn't for people that are just thinking short term. This is a long-term strategy and should be one of the things that you're doing, not the only thing. It's a tool in your toolbox. It's one of the things. And this is just where you're warehousing your capital. And when it becomes more and more powerful, the longer you have it. You could see in 15 years, there's 800,000 that went in. There's over $1 million tax-free in there. And you could see that year the policy, even though she just put in 50K, grew by $100,000. So it gets pretty powerful the longer that you do it and have it. And you have to have the big picture kind of view. On the back end for her, she's going to fund this up until age 70. But one thing I just wanted to point out, that if you look at her minimum is probably going to be, let's just say it's 23, it's probably going to be around 23,000. The dividends cover that by year 13. So her dividends cover her minimum already. And she has a max of 50 that she's putting in from year 2 to age 70 over here. At age 70, she's put in 1.55. There's $3.3 million in there tax-free. Now I'm going to ask folks, if you had a 401k, how much of that 3.3 million is yours? If you had an IRA, how much of that 3.3 million is yours? Is it 50%? Is it 70%? Is it 30%? We don't know, right? We don't know. So the reason that we have this is we know that's mine. It's tax-free. And she will be able to draw income from 71 to 90 of over $230,000 per year tax-free. So you know that there is capital there tax-free, and there's a death benefit, of course, of 5.4 million. Now, she passed away at 65. She had $2.3 million tax-free in her policy, but her death benefit is 4.7. So she gets a multiple. It's almost double. Yeah, almost double of her cash value that she gets and a death benefit. Let's look at another case here. Here is a male 60. By the way, this happens a lot. At 59 and a half, we have so many people working with us to try to get money out of 401ks and IRAs and fund it as quickly as possible. In this example, this male put in $1 million over 5 years as quickly as possible into this policy. Why would you move it after 59 and a half into one of these policies? Because you can access the cash value up to 95% at any given point in time. And now it's tax-free. So you paid the taxes as you take it out now because you know what it is now, and you can have a strategy which helps you reduce it legally now instead of waiting for it years down the line. As you can see, that because this person funded the policy pretty aggressively, there's over $1 million in there by year 6, and in 10 years at age 70, there's $1 million that went in there, 1.22 tax-free. And if you were to take income from this, there's over $60,000 a year income from age 66 to age 90. Yours is just a flat pay of $50,000 per year. And this is for the same female, 40. And you could see same thing, $50,000 per year. You could see there's 37,409 end of year one values in there. So there was probably around $35,000 in there within 30 days that she could have accessed through a policy loan and set up a line of credit. And again, from a short-term perspective, you don't look at it short-term, you look at it long-term. That's why you have it. It's part of a plan B. It's part of the place where you warehouse capital because it's tax-free. You can access it tax-free. The dividends are tax-free. And then again, the death benefit is tax-free. Yeah, by doing this, let's just see, flat pay around age 70. So there's almost 1.5 that went in. There's 3.22 million tax-free with $230,000 per year tax-free that she'll be able to pull from this policy. I want to share this slide quickly. So this is a pretty impressive slide. And when I said you've got to think big picture and play the long game, this is what happens in family offices, by the way. This is the difference between the affluent and ultra wealthy and just regular people. Is regular people, regular folks think, most of them short term now because that's how we've been programmed. But even if they think long term, we think in our life and maybe our children's life and maybe grandchildren. Family offices think in generations. They think 4, 5, 6 generations from now, what does it look like? One of my team members put this together, and he's under 30, so he was playing around with numbers and just got married, and he was like, how do I hack the system? Let's say if we had kids at 30 and every single following generation had kids at 30, what would it look like? But I thought it was just interesting because you're the first generation of kids at 30, and then they had kids at 30, and then the grandkids had kids at 30. And now here's 4 generations. By doing it that way and putting life insurance policies on every single family member and funding those policies, this family has 138 years of compound interest, uninterrupted compound interest, tax-free in 4 generations. 4 generations. Think about that. Think about that big picture for a family. Now, everybody then looks at the Rockefellers and they're like, how do they just get wealthier with each and every generation? Because this is what they do. They think big picture. They have uninterrupted compounding interest. They have a family bank set up and structured with life insurance policies like the one that I just shared you, which forms the basis from which every family member borrows, and they repay the bank. And if they don't, they pass away, and then the family bank gets replenished with a death benefit. Tax-free. So it's pretty powerful stuff. So there's a couple of things that you could do with this. Emergency savings. So What we do in our family, so we have 11 of these policies. I just set up one, my final one in December. So again, I went through the same exercise as every single person that reaches out to us at Producers Wealth go through. Where do you keep your capital? And I can't come up with a better answer than that. So that's why I added another one, because of all these things that I just shared. So our 11 policies, we always have a minimum amount in our family bank for emergencies. It used to be 6 months. We've upped that to 12 months. And right now we're just trying to put away as much cash as possible in our family bank. The family banking strategy, which I just scratched the surface. I'm creating a lot of content on that because a lot of people are interested in learning more about that. Your own banking system, funding it, establishing line of credits so that you can grow your business and grow your investment portfolio. Tax-free retirement. Folks that are very nervous about the tax situation in the United States, you should be nervous regardless of where you live about the tax situation. Governments are bankrupt, all of them. There's approximately 200 of them. They're all bankrupt, all of them. So there's only one way for governments to find revenue. They're going to raise taxes. So there's a strategy for that. Universal Life Rescue. There were a ton of bad policies sold in the 80s and in the 90s. We rescue about 2 to 3 of them every month. Inheritance multiplier. That's part of the family banking strategy. Volatility buffer. Here's the story I'll share quickly. This is real life stuff. So in 2020, I had a client that she called me. She was basically in tears because they retired in 2020. Could you pick a better year? Really? In 2020, they decided to retire. They had a 401k, then an IRA, but they set up life insurance policies with us, I think, in 2017, around there, 2016, 2017. I think it's 2017. Anyway, she called me and she was freaking out, panicking and saying, what can we do? Because the stock market, for those who can remember, in March of 2020, got hit pretty bad. I think some accounts were down 50%, 60%, 40%, depending on what your portfolio was organized in. But they took a big hit. So where would they get income that year? You could take it from your life insurance. Take income for 2020 from your life insurance. Then the market came back by the end of the year. And in 2021, they just moved it to cash inside of their retirement plans and took income from their qualified retirement plans. And we've also set up a tax-free retirement strategy for them, now moving capital into more policies because they don't want to live through that again. But it's a volatility buffer. If you're an investor and you have in your own real estate, I know you would be shocked to learn about this, but sometimes people don't pay rent and they break stuff. You have cash that you can use to fix it and to sustain the property, which this, by the way, came in handy in 2022 and in 2021. And you have cash to go and buy more properties when they go on sale. And the other strategy that we talk about is you can lock in your health, buy your net worth up front, and it's through a convertible term that can be converted into more of these policies. So if you're interested in exploring options for yourself and your family, you can go to yourcustomstrategy.com. There's a form that you can fill out, and my team and I will be in touch with you. I think we can answer a couple of questions if you want, Dennis. I cannot hear you. I think you're trying to.
Oh, sorry, I was on.
There
mute.
you go.
I'm on the chat. If anybody has questions, feel free to ask them. Let me see. I'll check Q&A as well. I had a couple MC from the presentation. I wanted to say a comment is you were talking about business lending right now. I was just having a conversation with someone in my network, and he was telling me how basically businesses right now, he was talking to a banker today, and the business line of credits right now are drying up because the banks are scared that so many small businesses are basically month to month. And I was talking to someone who recently bought a commercial landscaping business, and what ended up happening is he bought the business in November because the bank kind of screwed him over. They were supposed to close in October. So what ended up happening is in October, you get landscaping revenue. In November, you don't. And then on top of that, this has been the warmest winter ever in the Northeast. So he didn't get any of the snow removal contracts. So now he went scrambling basically for the last 3 months, and he's paying like 18 to 20% interest on some of these line of credits, but he really doesn't have a choice. He's got to keep that business afloat. He just bought it 3 to 4 months. So something like this is perfect for a situation like that, because I think the last time I took a policy against my loan was 2-3 years ago. I think I was paying 5%. What are the current rates for someone tapping in these days?
5.7% right now. And I'll add to your story. I'm one of the folks that, and maybe there are some folks on the call too, that lived through 2008, 2009. It was bad. We've had a heck of a run. From 2012, I would say, straight through to 2022. It's a little bumpy. There's still opportunities now, but we've had quite a run. It's been an unbelievable run if you just look back at it, right? In the real estate space. But I remember what it looked like in 2008 and 2009. And there's a lot of new people in the investment world that's come into our space. And I always say, I saw it all. Suicides, divorces, bankruptcies. Like, it was bad. What were some of the things that made it so bad? Liquidity dried up. And I was one of the folks that were fortunate. I didn't get clobbered as hard as most people. Look, you didn't come unscathed through that, right? Your net worth went down during that time. If you had real estate, you took a couple of punches. Some of us got knocked out. I didn't. I always said would have made a better story now if I did, but I didn't. I was lucky in a way, but one of the things that I learned, my biggest lesson, was I saw how quickly liquidity dried up. And I had HELOCs. That HELOC was gone and you couldn't find anything. When it gets bad, and it was really bad, and I'm not saying it's going to be like that again, but markets go up, down, and sideways. It's all cyclical. So when it is in a situation like that again, it gets really hard and really bad. So one of the things that I said to myself is, I'm not going to put myself ever in that situation again, because I saw folks that did have access to capital pick up assets. And I lived in Chicago during that time. The assets that they were picking up is stuff that it was stuff that 3-4 units that was for 30 to 50K they were picking up. With these things were valued at one stage at 800,000. It's probably back there again. It was nuts. It was a sale of a lifetime, and I didn't have cash. It was Black Friday, and I was broke. I couldn't buy that big screen TV that I wanted. But kidding aside, so what I'm looking at is, and you're 100% correct, it's already drying up on the business side. I can see how it will dry up on the HELOC side eventually. So you want to have capital in a place where you can access it when you're going to need it, because you're going to want access to capital. And just knowing from my past experience, nobody has all the answers. I don't have a crystal ball. I can't predict the future, but I knew what happened the last time. And if it looks similar, I want to have capital in a place that has guaranteed access to a policy loan, like in these life insurance policies. And right now they're at 5.7%. So interest rates are going up. So it's always kept me a better investor too, because some deals are just not making sense right now at that 5.7%. So I just don't participate in them.
Yeah. And when I was talking to experienced investors in March 2020, the one piece of advice they were telling me basically was, if you have any open HELOCs, go cash them out. Go cash them right now. Just max them out. You'll pay your 5-6% on them, whatever it is. Just hold on to them, because you want all that capital. Because the first thing they do, and the first thing they said was, if it's anything like 07, 09, they will freeze them on you, but they can't freeze them if you tap them. So it's interesting. Yeah. The other thing I wanted to mention was, I know on one of the slides you mentioned that they don't come with deductions or policy premiums.
Yes.
Now, how does it work if a lot of people on this call might have a business LLC? What happens if the business LLC purchases these policies for the principal? And then with those deductions at that point, I know you're not a CPA, so you're not giving financial advice, but is that a way to actually get those deductions at that point?
So one of the partners that I work with on business designs, he used to work for the IRS. And so I have learned a lot from him. And the designs that we've come up creatively, always using his kind of terminology, he's like, MC, you don't want to play in the sandbox with the government. Have a separate sandbox. So a lot of the ways in which you could get some value from this from a tax standpoint is you set this up separately for you. Your trust owns it. You're the beneficiary of the trust, or you're the investment trustee if it's a domestic asset protection trust. Again, I'm not a lawyer, just giving you an idea here. Or you just own it by yourself. It's separate. Then you can loan the money to your business or LLC and give your LLC or the business a note. The business then repays the note with interest back to you. And that is tax deductible for the business. And of course, you'll get a 1099 because you're earning interest from it. I've never done this personally, just a disclaimer. It hasn't made sense in my tax situation, but it has made sense in certain situations in other people's tax situation. But that's one way of doing it. Now, this high cash value life insurance strategy, where we have had folks that actually deduct life insurance premiums if it's term for a buy-sell agreement, like within the business contingency plan, and there's no cash associated with it. It's purely just death benefit. Then it makes sense to have the business just pay for it and write it off, the same as the disability that the partners would have and other business contingency strategies. But when it comes to cash, as soon as you get the government involved and you take a tax deduction, now you've opened up yourself to a lot of different scenarios which you never wanted to get into the first place by doing the strategy.
Okay, that's a great answer, MC. Thanks for clarifying that. The other question I had for you is, I guess in the last 18 months, 24 months, I've seen like a new spin on these policies, right? It's a one-off payment. You go and you then go right away and collateralize it with a third-party bank who will then make the premiums from year 2 to 10. You rack up a tons of loans, but in theory, the cash value will always be higher than those loans. And it's a way of juicing up the spread, so to say. What is your take on these policies? Like them, hate them, and if you hate them, why?
So that is a very sophisticated strategy, which I've seen all of the exotic stuff. It's called premium financed life insurance. So we actually do that. And we do that with folks that have a net worth of $20 million and up. There is a different reason why you would do those than what a lot of folks are sharing. They're trying to show, oh, you have leverage and you're growing it. And they're showing projections, usually using universal life policies, which is based on the stock market, which is based on average rate of returns. So that whole thing is that presentation should start with once upon a time. What we do is we do it as part of estate planning. So there's a couple of ways that the strategies from a very sophisticated life insurance strategy. So the first thing is access to liquidity now. That's what I just showed you, producer's capital account, this strategy. Cash now, set up your high cash value life insurance, your dividend paying whole life insurance policy with a mutual insurance company, and you have cash for your business and your investments now. Then there's a second strategy, and that is getting your maximum death benefit amount. Now, when your net worth is under 20 million, what you can do is, let's just say you set up a policy and your total death benefit is, let's just say 5, but life insurance will underwrite you for 20. What you can do is you can add 15 million in a convertible term. So you have 5 million whole life, 15 million in convertible term, and now your total death benefit is 20. So if you die at that stage, your trust or your beneficiaries get 20. Now, why is that a good strategy? Number one, it's the lowest insurance cost for that 20 million. You have cash now, access now, through the high cash value, and you have the convertible term, which you locked in your health at the time when you put that up, that can be converted into chunks throughout that 20 years that term is good for without medical underwriting. So you've set yourself up that you'll be able to set these policies up for the next 20 years. And that's what I did that personally for myself too. That's why I still have some convertible term. And the policy that I set up for myself in December, I actually converted some of my term over. Now that's a second strategy. So first one, cash now. Second one is cash liquidity at your death to your trust or your beneficiaries. Now then there's a third one, and it gets a little bit sophisticated. So you can have a trust, buy a life insurance policy. Now, instead of funding the trust where there's gifting now involved, and again, I'm not a lawyer, and I'm not an estate lawyer, but there's a limit to the gifting that you can do from you into that trust. So how do you get around that? If your net worth is over 20 million, what banks and financial institutions and family offices lend on this too, they'll lend you the money. They'll lend the trust the money to buy that policy. It gets around the gifting. So now there's no limit on gifting. You could fund that trust. So let's just say they lend you $1 million for 10 years. Now you've got $10 million that just went into that trust, got around the gifting, is in there tax-free in the policy. And in 10 years, you'll probably have 12 million in there tax-free. You take a policy loan in year 11, you pay back the banks or the family office that you borrowed from. And then now you're netting, let's just say 2 million tax-free in there with your death benefit, and your policy is in there. That's one of the there's so many different strategies with finance life insurance. When does this fall apart? The interest rates are challenging in that space, number one. So when you have exotic designs like the stuff that I've seen, they call it Kaizen. It's when you pull all these funds together and now they're lending on these policies. There's very thin margins for errors. So if one thing's off, remember, when you and I try to control something, if you have one variable, it could be challenging. If you had 2, harder, 3, more harder. When you literally have 4 variables, whether it's interest rates going in, the stock market needs to do this, the life insurance company needs to credit this because they have to be profitable, so their crediting has to be at a certain level. So you have 3 or 4 variables which you can't control. That's why I don't like it. That's why it's too exotic for me. We prefer the trust, the proven things that have been done for a while. These premium finance life insurance policies have been done, for a long time by very wealthy families. They do them in family offices all the time. Our partner that does that within our firm, he spent almost 2 decades in the family office space. And I've learned a lot from him why these exotic things, when it comes to that financing structure, isn't something that you would want to pursue. Does that make sense?
Thanks, MC. Yeah, no, I think when you hear something new, they're gonna sell it. Yeah. And that's why it's always good to hear the other side of it. MC, so we just hit an hour. I can't thank you enough for coming. There are definitely subsequent webinars I would love to do, especially on family offices, because I'm deep diving that as well right now. Definitely check out the Producer's Wealth podcast. You have a lot of great content on family office, and it seems like you're just starting to scratch the surface. So I can't wait to listen to some of the material that you have on that section. And what is the best place for my investors to come to reach you?
Yeah, so if they want to, hang on, I just wanted to bring up that slide. Again, and then it goes away. That was funny. Let me do this quick. I'll just forward to that slide quick. You might have to just edit this part. Oh, okay. yourcustomstrategy.com or go to just producerswealth.com. yourcustomstrategy.com will take them to a page. If they want to fill out a form, they can do that. And then myself or my team will be in touch with them.
Awesome. MC, have a great rest of your night. Thank you so much for coming on.
Thank you so much for having me.
Take it easy, MC. Bye.
Bye.